Hey everybody, I'm Jonna and welcome to Trading with Master Jack. In this video we're going to be speaking about the stochastic indicator. Now overall I'm not the biggest fan of indicators exactly, and I just use them really as a supporting tool. So I'm very selective on the indicators that I generally use, and I do not always use them as originally intended. Because it just generally it doesn't work that way in realistic market conditions. It works only in specific cherry-picked or isolated type of moments. But yeah, we'll get into that in a second. So what is the stochastic indicator? It is a technical indicator for generating overbought and oversold signals. The general rule of a technical indicator that generates overbought and oversold signals is that when it's overbought you would go short positions, and when it's oversold you would go long positions. But as mentioned, it doesn't always work in all market conditions. It has to be used in context, and we're going to be speaking about that. It is a momentum indicator as well. When and how is it used? For me, I use it to help confirm when I'm in an area of value, as I've explained in what is a trading plan part 1 video when using area value. So the rule is generally when in overbought you go short in a range. When in oversold you go long in a range. But I also actually when in overbought I also go short in a downtrend in the pullback. That is the condition, and I'll be showing you a good example on that. And when in oversold you go long in an uptrend in the pullback from an area of value. So those two last points is very important to be done from an area of value. The stochastic application in a range, which is the traditional way. We've got our resistance line that we plot just over there. And then we've got our support. That's on the early part of the chart that you would plot these. And you'll actually see that the price is going upward, forming new high lows. So it's almost an ascending triangle, but yeah, it's generally in a range nonetheless. You'll see over here where we have our oversold condition, and our entry position would be then on top there. So you would go long when it's oversold at support, which is our area of value, and you would go short in a sell position when it's overbought at resistance. We actually had a really good entry trigger there with our shooting star or even gravestone doji. And over here as well is technically entry point as well at the oversold, where we had our resistance. There's just a little blob of price on top there. But that happens in markets sometimes in their opening or closing, that they can form these gaps. Over here is our oversold again, nice entry point there, with a dragonfly doji or a hammer, whichever, it's the same more or less. And then we go on to the stochastic in a range again, just showing a more clearer range possibly. You'll see there is your entry position, a shooting star. So you're going short when it's overbought at resistance. There's our overbought scenario. And there is our oversold. Now technically it's not necessarily oversold, because oversold would be classified as going over this region here, but as you can see, a very strong hammer had formed there, and this is technically at support, so it was close enough to have entered into position with your stop loss just beyond this point over here. And as you can see, it did go upward, and then there's technically another entry point when it's overbought and it's at resistance. We even have this formation of the shooting star over there, and we carry on there. Another oversold situation at support with a bullish engulfing candlestick. So you can see there's several entry opportunities within this range as we're using it, going on there as well. It just goes on. But the thing is, with this type of scenario, you'll see not every range is perfect where it's going up into resistance and down into support. It tends to get somewhat choppy sometimes. but the general rule then within a range, you would then look for these type of opportunities of entry, especially when the range is going over along the 200 moving average. But of course, because in this type of range it is below the 200 moving average, going for short positions would be the best choice, because you don't know at what point it would continue in a downward trend. So at least then, if you caught it at the right place, in the right position from area value at resistance, which along this dynamic resistance of the 200 moving average, you would be set up for a better risk to reward ratio should you catch the downtrend. Stochastic application in a downtrend. This is now when the market condition or the market direction is in a trend. We've got our dynamic trend line over there, which acts as a resistance. We've plotted a resistance line as well, support line there as well. If it's on the early stages, it would be support line. Just a quick pause. Just remember, in a strong downtrend, the stochastic mostly remains in the 50 to the 0 zone in the higher time frames. So you can see then in this zone was a downtrend, a very strong downtrend. In a range, it goes further out into the overbought or oversold conditions, but in a trend, it generally is at the bottom, and in a downtrend, it's down here. We'll get to the uptrend just now. Now we look for opportunities. Now technically, that would be your opportunity. You go short when overbought at resistance. And that's where our resistance came into play, and there was even resistance along the dynamic line over here that it formed. Dynamic resistance, so that would be your area of value in this area, and that's the pullback that I was speaking about. So, and I put overbought in inverted commas because it's not necessarily overbought over here, because overbought conditions would be up here. So in a sense, I just want you to think a little differently on how the stochastic runs in its momentum, and that its bandwidth, in a sense, this band is much tighter when it's in a downtrend. So therefore, going into the 50 zone, maybe a little past that, would be considered then hypothetical overbought, even though it's not necessarily overbought. But that would be giving you an indication that it could be an area of value within this downtrend to enter over there. It'll make clearer sense just now. And over there would be another entry position, but this is now not along this particular downtrend. Technically this would have been your next entry point, but I don't like when the stochastic is too flat, getting too flat like that, then I generally avoid it. But your next entry point would be in this pullback into the dynamic resistance of the 50 moving average, which now it's starting to look more like a range formation over here, from this position to here and back down there and on top there. So it's looking more like a range, a small range area similar to this one over here. Let's just look at that would be your support over there at that point, and then it came into support again over there, and your next entry position would then be there, and that's why I say it's looking more like a range going into there. So you're still going short when overbought at resistance, and this type of area I generally wouldn't trade at because there's too much volatility or indecision in the market direction. So you can see it becomes very choppy. And over there was the next opportunity when it became overbought, and that was in a stronger pullback in a sense of this downward direction, and you could catch some profits there as well. Let's look at a more zoomed in example, if you can say, using the stochastic in a downtrend. Over here we've got our dynamic trend line showing our downward price direction, and there is our stochastic momentum here. In a strong trend, the stochastic mostly remains in the 50 to the 0 zone in the higher time frames, still relatively high time frame, but here you can see where the downtrend is generally down there, and you can see all the false signals for buying into a position if it's oversold. If you try to buy in here, buy in there, buy in there, anywhere along this way, it's all false signals in a downtrend. So you wouldn't apply that method within a trending market. So on the early start of our trend here, there was our buying opportunity, or not buy, but our short opportunity, our sell opportunity over there. Our next one was over there, going on along the 50 moving average. There it pushed back against our dynamic resistance of our trend line, a fuller one, fuller pullback there in the overbought region. There's our next one. Now our 50 mark line would be around this area, so then that's why I say in inverted commas overbought. It's kind of gone over there, and that would be a good entry position for another short. And it just carries on over there as well. Another one, and another one further closer to our area of value. Now technically our area of value is alongside this dynamic resistance, but as you can see, there isn't always many opportunities in a strong downtrend for it to enter into that area of value. So that's why we should consider using the dynamic moving average, naturally, that acts as dynamic resistance. And you see in this area, technically one would have possibly entered into a position over here thinking it would be similar to that, going short, and then you would have had a stop loss in this upward area. Now generally when the price direction goes a bit sideways like this, I know this one almost looks like it, but it still generally went in a downward channel here, but over here it went quite straighter, if you can say, where your resistance is here and the support is over there. So then I would rather wait to see what's going to happen with the price, because it might have a pullback closer to the dynamic resistance over here of our trend line, or to the dynamic resistance of the 200 moving average. So I would wait to see what type of signals we can get, which one gets a nice entry trigger right here with that bearish engulfing candle. Not a very strong one, but one nonetheless. And you'll see there's our overbought scenarios, and then we could enter into there. A stochastic application, an uptrend, similar as the downtrend, just the opposite. We've got our dynamic support along the way here with our trend line. You'll see here in a strong uptrend, the stochastic mostly remains in the 50 to 100 zone, and in this case when it pulls back to here towards the 50, into the 50 area, going a little bit over that would be, inverted commas, your oversold positions, ideally to enter into going along the uptrend. So let's just look at our positions we have over here. Well, we've got our early position over there, going long when it's oversold at support. This would have been a support area, most likely. With the chart previously there was price action, so that had a support area. So you could have kicked in there already from this range, in a sense. Going on to here, I just want to show you this particular example why you wouldn't go short in an uptrend, going by this being the signal to go short, because you can see there isn't much price movement here in the upward direction, and you'll just get stopped out too easily. And that's why going against the trend in this context is not advisable. And then moving on, we've got our entry position over there, a nice bullish engulfing candlestick there, and you can see there it is in our 50 zone. Next one over there, and the next one is technically over there, a bit of a stronger candle movement upward there, but can be an entry nonetheless. Here as well, technical entry, but as I don't like when it goes too flat. And there's another nice entry with our dragonfly doji, and over there would be our last entry within that one. That one can take. So as you can see, it remains generally within this zone, and that our pullbacks within our area of value along this way can be confirmed in a sense along this stochastic indication. But as I say, I use it as a supporting tool. A stochastic indicator recap, when and how to use it. As I say, it generally helps confirm the area of value. And when in overbought, you go short in a range. When in oversold, you go long in a range. And when in inverted commas overbought, you go short in a downtrend within the pullback. And the fourth one, when in inverted commas oversold, you go long in an uptrend in the pullback. So that's basically how I generally use the stochastic. As I say, I do not put too much emphasis on indicators in general, as I prefer to prioritize market direction and area value, and then touching off with a good entry trigger. And that I do explain in good detail with what is a trading plan. And but as I say, there's still some value in the stochastic indicator and in some indicators, and I very selectively use them. And this is basically how I use the stochastic. If you enjoyed this video, hit that like and subscribe button so that you don't miss out. Happy trading, and may the trend be with you.